Hey guys, Whitney here. Welcome this fine Tuesday afternoon. I am joined by Taylor from our investor relations team.
What's up?
Ready to
How's it
rock and roll?
going? Ready to rock and roll? I did my facial care routine, put on some sunscreen. My girlfriend has been advising me to do it, so I am ready to go for this
Did
webinar.
anybody tell you that this is actually like recorded and on a podcast, so you don't have to go through all that?
Oh, see, well, even if it is recorded on podcast, now they can imagine just my immaculate, just like skincare routine and just no blemishes at all as they're listening to this.
Awesome. Well, guys, we've got a full house today. I'm super excited. And, just for those of you, if this is your first time joining, this is my name. Let's first start off there. Let me introduce myself. My name is Whitney Elkins-Hutten. I'm the Director of Investor Relations Investor Education. I gave myself a promotion there.
Ooh.
Let's rewind that. I'm Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. Very familiar with the investor relations role, though. And this is a live show, so where we take a deep dive into various topics related to passive investing, so you can go into your first or next deal with confidence. And if you haven't already, be sure to register at PassiveInvestingWithWhitney.com for future masterclass sessions, see our open deal, and schedule time with me or anybody on our investor relations team. So as I already mentioned, I'm bringing in a very special guest with me today, Taylor, who is going to be joining me pretty regularly so we can go through some of these more in-depth mechanical topics around passive investing. So hopefully, I don't know about you guys. I know for me, somebody starts talking about the math around passive investing. Well, I know I need to know how to do it is like watching paint dry sometimes. It's not the most glorious topic to talk about. So I'm super excited to have Taylor on with me. We are hopefully going to add value, not only in helping educate you on investment returns today, maybe like add a little bit of fun in your life for Tuesday afternoon.
Fun free lunch, as you're watching
Exactly.
this.
All right, so Taylor, I know we were breaking down right before the show. We're going to go through all the different investment returns that limited partner investors should have their eye on when they're reviewing a deal. But I think we need to just start off with a quick definition, a delineation really, that there are returns and then there are actually performance hurdles. And a lot of times investors get those kind of confused when they're looking at a deal. And it's really important to understand why there's a difference here, right? So the returns, what we're going to touch on today, are actually the risk or the rewards for investing in a deal, what a limited partner could potentially expect or what they're hoping to get as a return on their capital invested. However, the return hurdles, like I'm going to throw a word out there that might confuse everybody, preferred return, guys, not a return. Taylor's going to help demystify that for us, are actually milestones to incentivize the general partnership for performance. So, okay, let's start off with the basics. I always like starting, walk before we run. What are the top three returns investors should be really looking at when they're investing in a deal?
Yeah, so with the top three returns that people typically look at when they look at a deal, there is typically the cash on cash return, the equity multiple, and the IRR. Now, I wouldn't say that each one of those is way better than the others because they all sort of paint this picture as we look at an entire investment opportunity. We can't necessarily look at one and just say, hey, by rule of thumb, I'm only looking for a 2x multiple with a 10% cash on cash return. We need to see the entire picture of an actual investment opportunity. And so, breaking down, I'll just go through the three different metrics, and actually came prepared with a little graphic.
You did.
Here. I did. Let me share my screen here.
And while Taylor's getting settled, you might hear what sounds like
people cutting trees.
People are cutting trees.
People actually are cutting trees outside of my apartment. So my apologies if you could hear them. All right. Can everybody see that?
Yeah.
Okay, so the cash on cash return, starting out with the first one, I feel like this is the most common and also just one of the simpler, easier to grasp type of returns. It just intuitively makes sense. And so you would take your annual cash flow that you received and you divide that by your initial cash investment. And so it's a nice starting point to when you're trying to understand the project. I mean, if you have invest 100,000 and you have a 10% cash on cash return, that's going to be 10,000 for the year. If you invest 100,000, have a 7% cash on cash return, that's going to be 7,000 for the year. So, I mean, that is pretty simple, but in terms of I put on another scenario at the bottom here, and this is more of a nuanced scenario that isn't necessary. It's sort of like tricky, because if you say that you have like a $10,000 annual cash flow for that year after a refinance, for example, or a capital event, then that could really skew your cash on cash returns. And that's where your cash on cash could potentially jump, as some operators might try and portray that, right? So the bottom here actually models for a refinance. And this is really just strict numbers of, or simple numbers for that fact of just showing how that number can jump up. So year one, 10,000, year two, they refi, and let's say they give you back 50,000. You still have 10,000, but in years 3, 4, and 5, let's say that you still are achieving 10,000 in annual cash flow. Well, some operators would take that cash on cash return percentage and base it on your actual principal that's in the deal. And so instead of your cash on cash percentage being 10%, now your cash on cash percentage looks like 20%. And so if you look throughout the holding period, it could be 16% cash on cash return, when in actuality, I mean, that's just based because of that refinance, and how much capital you have in the deal. So I think it's definitely a nice starting point. Doesn't paint the entire picture, just because it can drastically change in case there is a capital event, but it gives you a nice idea of cash flows that you can expect throughout the year.
All right, so cash flow, one return is annual cash flow divided by investment cash, or your initial capital invested. All right, so that's one return. And just to sound it back, it can look a little manipulated on the offering memorandum, depending on what the operator is doing in there and what they're disclosing they're going to do. Like if there's going to be like a supplemental loan or refinance. But I know the question is going to come in. We don't model any sort of supplemental loan or refinance into our numbers in our offering memorandum for that specific reason, because we want our investors to see the true cash on cash return. All right, so what else do we got? Equity multiple?
Yes, we got the equity multiple next, and I'm actually going to try and pull it up a little bit because I see that it's hard to see. Can you see that a little bit better?
Yeah.
Oh, perfect. Oops. Let's see. Hold on. Alrighty. Oops. There you go. Okay. So next up, we have the equity multiple. Oh, dang. Hold on. Give me one sec. Yeah. So the equity multiple, let me try and do this instead. Can you actually see that?
Yes, we can see it.
A little bit better. Okay, perfect. So the equity multiple, another, I would say, common and pretty simple return that people can like to utilize, and almost creates a rule of thumb. You might hear people saying that they're only looking for a 2x equity multiple, or you're looking for a 2.5x equity multiple. Now, what this really means is how many times you are multiplying your investment over the holding period. So you're multiplying your principal, your investment, by the equity multiple, and that is how much total profits plus your principal you have achieved throughout the holding period. So if you invested 100,000 and then at the end you profited 100,000, so now your new capital balance is 200,000, your equity multiple would be 2.0, 2x.
You doubled your money.
You doubled your money.
And you doubled it. Now, just a quick question, Taylor. This, when you're calculating this, this is both the distribution as
Yes.
well as any capital gain, correct?
Yes, that's a great distinction. So this culminates both the cash flow profits that you get, all the distributions, whether it's quarterly or monthly, so it's for monthly, all the distributions leading up plus profits that you get from the sell.
Okay, awesome. So does it take into account time?
So that's going to be my next question, or I mean, my next statement. And I mean, the equity multiple, like I said, it's a nice starting point, but it does not factor in time. And so as you can see here, we actually have the same equity multiple at the bottom. We both are profiting 100,000 for both deals. But it takes, one scenario is 5 years. The other scenario is 10 years. And so even though the equity multiple is the same, it doesn't factor in the amount of time that it actually takes to achieve that equity multiple. And in a way, I feel like this, it can also be sort of misleading as well, especially if you're not in sessions like these to understand how these returns are put together. Because, you know, if somebody is putting out a, let's say, a 5-year deal with a 2x multiple, and somebody else is putting a deal that has a 2.5x multiple, I feel like people's minds would typically think, oh, 2.5x multiple, great, that's even better, but they don't realize that it's going to be coming within 10 years. So something to keep in mind, especially when you are looking at this metric, is how long is it going to take to, let's say, double your money or multiply your money by that equity multiple.
Well, and I think, you know, just kind of stack on top of that. I mean, that's the kind of the same thing with the cash on cash return. Like you can have, you know, somebody say, I have an investment that's going to give you 30% annualized return, you know, or cash on cash like every single year. And you're like, fantastic, but how long am I in the deal for? Like
yeah,
5 years,
exactly.
10 years, 30 years, right? Like, you know, and that really can impact your overall return. So I love the fact that you went over cash on cash, equity multiple, because these are important, because these help us like center and, you know, compare investment to investment. But you did mention IRR.
I did mention IRR.
And IRR is, guys, if you like calculus, here you go.
We're about to do the theorem for this entire equation, just to prove that how this works. No, okay. So the formal definition of IRR is the discount rate that causes the net present value of all cash flows throughout the investment to become equal to 0. I have read that multiple times, and still it is, when I was first learning about this, it still made me go, huh? And if we were to reframe what this internal rate of return means, it is really the time adjusted return on your money. So how much money is put out at time 0? So when we actually invest the money, and then also taking into account, when is that actual money coming back to you throughout the life cycle of that investment? So when did it go out? And then when did it come back in? And the whole reasoning behind just this IRR is, if we get money sooner, cash in hand today, you can theoretically take those profits and then redeploy them and generate those returns elsewhere. So it's the whole idea that cash in hand today is worth more than cash in hand tomorrow. Receiving those cash flows today is more important or more valuable because you can return those and generate a return somewhere else. And so if we break it down, let's say I give Whitney, I give you $100, and then you place that $100 in a place that gets a 5% return. Next year, you get $5. If you did not place that money in that 5% return, your $100 a year from now is theoretically only worth $95. And so that's really it's sort of
why is it only worth $95?
Well, it's because we missed out on the opportunity of investing for
opportunity cost, guys.
Yeah. So in a way, it sort of quantifies the lost opportunity of what you could be getting if you were to deploy your profits earlier, at an earlier time. And so It takes into account the time. So for the next slide, I put 3 different scenarios. One, or actually for all 3 of them, you get the same profit of 100,000. But based on when you're receiving capital and return back, highly skews the IRR to be completely different. So for that first one, let's take a development deal. We invested 100,000. At the end of year 5, we sell, you have doubled your money. You have a total profit of 100,000. You only get your IRR for your IRR is only 15%. If you have a value add syndication with a refi, you have a refi back in year 2, you're still getting cash flow. Your IRR is 22%. But for an early exit, you can really see your IRR really jump because you're getting that extra profit, that 100,000 a lot earlier, with the intent that you're going to also invest and generate returns with that cash. Generate returns with that cash that you receive at an earlier time frame. Right.
And I think this leads into, not to go down on a tangent, but, sometimes, when we talk to investors, there's a group of investors, and maybe some here that are like, I want to make sure my capital stays invested for, 5, 7, 10 years, because I don't want to have to go find another investment. Right.
Yeah.
But this is showing us, though, is if the operator can actually hit the return and exit in a profitable manner, say in year 3, we're accelerating our returns greatly over if we did hold for a longer period of time. So therefore creating velocity with our money.
Create the velocity of your money. And then if the operator has the option to 1031 too, and you can redeploy that into the next deal right away, then, you still increase the momentum and velocity of your money. I really like what you said about that.
Awesome. Okay. So, you went over cash flow, equity multiple, and internal rate of return. And I know you and I were talking before the show is, what a lot of investors that we speak to are just like, I want to know what your preferred return is. So Taylor, I'm going to, and we talked about it right at the beginning of the episode that a preferred return is not a return. Where does preferred return fit into all this?
Yeah. So the preferred return is, it's more like a feature. It really doesn't measure the actual performance of an asset. But what that preferred return is it's really dealing with the structure and incentivizing the GPs to make sure that, one, the investors get paid first, and then once the investors get paid, we can also get paid afterwards. And so it's investors' return. If they win, we win as well. Now, the preferred return is dealt with your cash on cash return. And so as let's say there's a 7% preferred return, your cash on cash is below 7% throughout the holding period. Maybe you're stabilizing the asset. You're still accruing an amount that we would still owe you before we get paid as the operator. And so that's where that alignment of interest comes in, is you need to hit your 7% first, or whatever preferred return that it states, before we get paid as the operator. Awesome.
All right. Now, guys, I brought some live examples here because I want to pull this all together, because these returns that Taylor just went through don't operate in a vacuum, right? They operate in tandem together. And you need to also learn how. I want to make sure that you guys understand how to where, number one, figure out where they are in the offering memorandum that you might be looking at, but also number 2, like what happens if the NOI moves or the cap rate moves, or what happens to my potential return, either whether it's IRR or equity multiple. So bear with me, guys. I want to share my screen. Maybe. Gotta love technology. Amazing. Okay, so this is our, actually, this is Pick Storage 2. This is still open for us right now. And so if you guys are interested, we can definitely send you the offering memorandum on this, depending on when you're listening to this episode. But if you can see here, I'm actually looking at the break-even occupancy here on the left, but what we have here is like a sensitivity analysis. So what happens to that internal rate of return as the cap rate moves? Okay, and this is calculated in here also with net operating income. You know, as cap rate moves, as net operating income moves, what happens to the IRR? So here we're just adjusting one variable. We're only adjusting the cap rate here. And you can see, now we can see how our internal rate of return moves as the cap rate goes down, meaning market's getting better. But more importantly, what happens if the cap rate goes up, the market's getting worse, which, you know, if we're all talking about a recession right now, which seems to be like on every headline, I don't think we can, you know, you can't escape the news right now. Then, you know, investors need to be able to understand, you know, and look at this and be like, oh, my internal rate of returns has a range of possibilities here. All right. I'm going to stop share real fast and make sure that I went over my notes on that. Now, there's a rule of thumb whenever we're looking at like kind of a sensitivity analysis based on the cap rate moving. The rule of thumb is that you're looking for the 10 basis points or 0.1% adjustment per year of the hold. So if the asset's being held for 4 years, we want to see that spread be, you know, at least calculated or demonstrated, that at least have the operator look at the spread to where cap rates go up 0.5% or 0.5%. Now that's just a rule of thumb. There's no hard and fast like scientific data behind that, but you know, historically cap rates have not jumped that high that fast. So that's, you know, but you know, anything, you know, what did they say? Past performance doesn't predict future returns. So the big asterisk there, you know, that it depends in real estate.
Right. Well, I do want to add onto that too, because like when we take a look at that IRR is really based on a lot of assumptions, and we unpack just the reason why we're looking at that cap rate. We're really looking at the purchase price of what can we reasonably expect to sell, or at that capital event to sell that asset for. And so when we move that cap rate up, move that cap rate down, you know, we can reasonably expect to receive this, receive that. Now, let's say you're talking to another operator and they have 25% IRR. That's could be sort of a red flag, because they can either be really optimistic about where they're going to be taking that property years from now, and they're very bullish on what's going to be happening for the next 5 years, or maybe they're very bullish on a refinance. And so understanding now with the IRR, you can take into account the assumptions that they're making, like the cap rate, what is it going to do? But then even diving into a little bit further of like what rent growth that they're projecting, what NOI are they actually expecting to achieve, what expense growth are they projecting? Like, does this deal actually make sense, or are we just being very bullish and trying to go for that 25% IRR just to put it on there and gain those investors? And so taking into account all of it.
No, those are all great questions. And I think, you know, let's take the investors here through a tour of an offering memorandum. I'm just going to happen to do it on this one since I have it up live. So, you know, we've talked about cash on cash. We've talked about IRR, equity multiple. We've touched on the preferred return. I'll point out one other hurdle in here that a lot of investors see as a return, but it's really not. But let's take it on a tour. So a lot of people I know just look at the offering summary. And guys, this doesn't give you much clue on what to expect from the return. You know, we actually started a couple years ago directing people to the financials, so they weren't just looking at the offering summary or the executive summary. So here's a great page. I mean, this is how we have it laid out, is looking at your, again, you know, this is what Taylor was talking about right here. The year one, 5.5%, year two, 5.8%. That's your cash flow that you can expect. Okay. Annual return that the investor can expect. But this particular offering, if you look under partnership structure, has a 7% preferred return. So there's that delta there that accumulates. It's cumulative, and then at either during future cash flow or you know, it could be paid out with future cash flow at a capital event or at disposition. And then you've got, here we've got a nice return summary. Again, another part of the sensitivity analysis. And we can see as cap rates move, okay, that return, the return disposition, to that investor, how it moves and how that impacts the IRR and impacts the equity multiple. And it actually impacts the annualized return. So again, like I said, we've got all these variables coming in at play that can, how I always put it to investors is that I want investors looking at this and comfortable with the entire range of possible returns, and here I want to point out again in my little tour, we're entry cap rate of 4.04%. So if you notice here, all these cap rates are higher. So it's just all these assumptions are that the market's getting worse, okay, that the market's expanding. If the cap rate maintained at 4%, you're going to be knocking it out of the ballpark at higher than a 15% IRR or higher than a 2x equity multiple on this deal. That's amazing. And if it goes the other way down to 3.5%, even better. But we're really trying to help investors orient to a conservative underwritten approach. So, I hate to say under promise, over deliver, but that's really what it is. Just conservative underwriting.
Yeah. No, yeah, really under promise and over deliver. I mean, I was thinking about it. When actually has an investment gone exactly spot on to what those returns would look like? I just don't hear it very often.
well, that's the other kind of joke in the industry, and it's kind of said tongue in cheek, but people are like, well, have you always hit your pro forma? And I'm like, no, the pro forma is always wrong. and like I said, it's said a little bit of tongue in cheek, but it is, right? You're not going to nail those numbers perfectly. It's going to either, be a little higher, a little lower. We're erring on the side of being lower. That way, whenever we do hit, our track record right now is a 25% IRR on our deals at year 3, year 3 plus. That's awesome. Investors can actually orient to what our true performance is. All right, guys. I know we've gone through a lot of information here, looking at, cash on cash, internal rate of return, the equity multiple. We've touched on a couple of the performance hurdles, being the preferred return. We mentioned that there's another IRR hurdle that you might see in an offering memorandum as well. Those really play into the waterfall of a deal, which, we're going to do another episode over waterfalls. But really, I also wanted to give you guys a tour of what the sensitivity analysis was like in that grid of where you can see the range of returns and understand how all these things kind of fit together. If you guys have questions, jump on over into the chat box. We'd love to handle those now. And anyways, Taylor, do you have any, as people are populating the chat box, do you have any other comments and things that you would like investors to know right now about investment returns?
Yeah, I mean, in terms of last comment, just make sure that these metrics aren't the only things that you're going to be using as a rule of thumb. I mean, they can be a nice reference. They should really be used as a nice reference, but they shouldn't dictate your intent to actually invest in a particular deal. There's so much to unpack when we look at an investment opportunity. Be beyond the cash on cash return and equity multiple. Be more.
Well, go back and listen to the episode that we did just a few weeks ago on about, what are the 3 ways that investors can actually control a deal. And we never talked about returns at all in that. It was about knowing your goals, investing with, an operator that love and trust, understanding the market and what it's doing. And we don't necessarily mean the global economic market, but where is that asset actually positioned? And then looking at the business plan of the deal and underwriting that. And yeah, a lot of investors, I know, tend to orient, they're chasing yield. And, this is one metric, to underwrite in a deal, but it shouldn't be the only one. Taylor, thank you so much for joining today. This has been amazing. If you guys are joining live, don't go anywhere. We are about to start our after party. But until then, Taylor's dancing.
Yes.
Made me crack up a little bit. Until then, join me next week. And in the meantime, you can check out passiveinvestingwithwhitney.com to get access to future masterclass sessions and see our open deals. All right, guys, take care.
Oh, we do have a question.